Good evening, class, and welcome to our advanced taxation class for tonight. We are taking the topic concept of total profits. In our class today, we are going to be looking at what is adjusted profit, what is accessible profit, what is total profit. We're going to be seeing the format of these profits. So we'll be looking at tertiary education tax. Then we'll be looking at the objective, basis of computation, assessment and collection, management and administration of debt fund. Then we'll look at tax implications of classification of Nigerian companies, looking at the Finance Act 2019 and 2020. Excuse me. We'll be looking at the normal basis for computing companies' income tax payable and other bases of computing income tax, which is minimum tax and revenue basis and dividend basis. Then we're looking at dividend distribution by Nigerian companies, then treatment of excuse me, treatment of certain undistributed profits as distributed abuse. As distributed, then we have anti-abuse. So let's get right into our study for today. Now, the chapter we are considering explains what is total profit. Now we're looking at assessing limited liability companies to tax. So when we talk about companies here, what we mean is limited companies. Okay? Now, when a company is preparing its accounts, it will capture all its chargeable income that relates to that accounting year. Now, for the purpose of this class, we are going to be using primarily an accounting year from January 1 to December 31st of the same year. Alternatively, we might use July 1 to June of the next year. All right, so when a company is trying to prepare its tax, it's going to capture all the income for that accounting period. Now, that accounting period is what is stated in your financial reports. Okay, so your accounting period is stated it. Then, because of the concept of matching principle, the matching concept, it will bring all the expenses that is incurred for the same period. But now, for the purpose of tax, it is going to take only those that are tax allowable. So that means that if a tax accountant is preparing your account, it's going to be slightly different from the way a financial accountant is going to prepare your account. Your financial accountant is going to bring all incomes that are accrued or accruable for the year. But the tax man is going to bring all chargeable income for the year. These are two different things. The financial accountant is going to bring all matching expenditures accruable for the year and deduct it from all income accruable for the year. But the tax man will bring all tax allowable expenses that are tax deductible and deduct them from the chargeable income from the year. Then he's going to get something called a profit. But the accounting profit is the net profit. The net profit of the different from the profit of the tax man. And so the tax man calls his own accessible profit. Now, there's going to be um, a granting of loss relief. And when the loss relief has been granted, the next thing that is being granted is capital allowance. And when the capital allowance has been granted, that's the last thing before you get what they call total profit. So you see here, the what is being granted first. After you've got your accessible profit, you grant loss first. Loss before capital allowance. So loss is granted before capital allowance. So that's what you should take notes of. The loss is granted before capital allowance. So after capturing and getting after capturing the capital allowance, what you have left is called the total profit. Now, it is this total profit. This total profit is also called taxable profit because at this point, tax can now be applied on this profit. So you see here, in your financial report, when your financial accountant gets net profit, if the financial accountant goes ahead to apply tax, whatever tax is applying is only a provision because if he just takes 20% or 30% of net profit as tax, that will not be correct, technically speaking. And so, whatever he has done is a provision. And if a company take a step to make payments based on that, that is a kind of provisional payment. And one thing, the the tax man will be so happy if the taxpayer assess himself based on net profit because the tax he is going to be paying most times is going to be bigger. But sometimes it's going to be smaller. And so the tax man will now have to do his own calculation and, you know, okay, most times if you do it on net profit, it's going to be smaller. And so the tax man is going to do his own and do it on total profit and give you a revised assessment, which you have to pay. So you see where you don't have to prepare the tax. The financial accountant is not the one preparing the tax because they are using IFRS principles to prepare the financial accounting, whereas the tax is using the FIRS laws in Nigeria to prepare the tax. Now, we'll be mentioning some terms here. We mentioned something called the accessible profit and adjusted profit. Now, what is adjusted profit? Adjusted profit is determined by adjusting the net profit made by the company during the basis period. Now, you see, we said before that when a tax accountant is preparing his own account and the financial accountant is preparing the account, if both of them are to start from scratch, they're going to be getting different values of revenue, different values of expenses, and different values of profit. And most times, the company does not employ financial accountants and tax accountants to be running side by side. And what they do here is after the accounting period has ended, that is when the tax accountant starts his work. And so the tax accountant is going to look at the profits taken by, look at the account taken by the financial accountant and do some adjustments. And so there are some profits that are not supposed to be charged under the company income tax. For example, sale and disposal of an asset, the profit from disposal might be uh, a part of the other income in financial accounting or other comprehensive income. It might be stated there, but this income is not chargeable to CIT. And so it's going to be deducted from the income so that whatever income is remaining is a chargeable income. That's one example of the adjustment that's going to be made. Then all the expenses that has been, you know, deducted from the financial accountant, not all of them qualify to be deducted. I'll give you one example: depreciation. Depreciation doesn't qualify to be deducted. So because it has been deducted before, taxman will say, we don't have to qualify it to be deducted. Let us add it back. So they will add back those expenses that are not taxable, that are not allowable. They will add it back. Then they will look at things that are supposed to be taxable, but they are not reported. They're going to add them. Then they will look at some expenses that are supposed to be, allowed, but were not reported. They are going to less them. So you see, there's a bit of an adjustment here and there. And so whatever net profit that has gotten has now been adjusted. So it means that the financial accountant's net is different for the tax account. So it takes that net profit and adjusts it to suit the taxman's use. So that becomes adjusted profit. And it ends there. Now, it is called adjusted profit. I can see some questions coming up here. Okay. Someone is say is having difficulty hearing me. So if anybody else is having difficulty hearing me, can we write on the chat room that I am not being heard? Let me know what to do. I want to give us the other two people. If you cannot hear me clearly, can you speak now before I continue that you are not hearing me well? Okay. If you can hear me well, can you state that you can hear me well? Okay, maybe that's the question I should ask. If you can hear me clearly, can you write on the chat box and you can hear me clearly? Wow, nobody's writing. So I want to believe that the other people are not by their phones. So that is why they are not experiencing the technical difficulties. Okay. Oh, you can hear me clearly. Oh, that's fine. That's fine. I like this comment. Very, very good. Very good. All right. So, all right. So we shall be looking at it now that this is adjusted profit. Why is it called adjusted profit? It is because the net profit, it is because the financial net profit has been adjusted to adjusted profit. Now it ends at adjusted profit because two things have not been done from our our analysis here. We have not captured loss relief and we have not captured capital allowance. So when capital allowance and loss relief has not been captured, then it is adjusted profit. But what about if we don't have loss or we don't have capital allowance? Then our adjusted profit becomes accessible profit. Now let's look at total profit. Total profit is arrived at the deduction of loss relief and the granting of capital allowance. So the only time that total profit is different, is the same with accessible profit if adjusted profit is equal to accessible profit is when no loss and capital allowance. But as long as there is a loss, sometimes there's no loss. But as long as there's a capital allowance, the two will be different. After getting as adjusted profits, you need to convert to accessible profits by first deducting loss, then capital allowance. Remember our acronym here. We said loss, loss before capital allowance. So now let's look at the format. The format for total profit. Now, if you look at this format, let me explain this format. Now we have profit as per account. This means that this is the financial account. So this is financial account. So this is the net profit. So most times it is the net profit method that is used in preparing your profit, your tax. So it means the tax accountant does not start from the beginning to create his own account, although that is another possibility that can occur. But most times, to save stress, we take what the financial accountant has prepared. Then we add all disallowable items. We said before, those items do not qualify to be deducted, and they have been deducted. So we have depreciation, which I gave as an example. Another item that is added back is capital expenses on shares. So when you are paying for shares, you are increasing your share capital, maybe other expenses relating to shares. is a capital expense. And one thing is any capital expenditure, be it you are making a projection, or maybe you are doing a projection on your building. It's going to be a capital structure. Maybe you are preparing a drainage. A drainage is a capital expense. You are making an expense that is not a recurrent expenditure. This is something that is capital in nature. And so those items stands to be depreciated if they are uh, fixed assets. And if they are intangible assets, they stand to be amortized. Now, those things are capital expenses. Then we have rent disallowed. So any rent that is not allowed is disallowed. Example of rent disallowed is when you are the rent for your personal private use. Let's say your office space is in one of your rooms and you're living in a duplex, and one of the room is the office space, or two of the rooms are the office space. These are the only portion that is supposed to be allowed. So you now decide to put the whole rent. The other aspects that is not for office use are disallowed, and so you add them back. Then donations. There are some donations that are disallowed. We'll talk about it when we get to allowable and disallowable. Then we have general provisions for bad debts. Take note, it is the general portion that is disallowed. If it is specific, is allowed. Take note, it is provisions that we are talking about, because bad debt in itself has occurred. What is bad debt? This is debt that has cannot be paid back. But provision is we are looking at the possibility of it not being paid back. Somebody is asking a question. Somebody say, I can't see your screen. Wow. Okay. Let me stop sharing and share again. Maybe this time you'll see the screen. Once you see my screen, let me know. I think my screen can be seen. Then we look at diminution in value of investment. If an investment has reduced in value, which is impairment and so on, or a kind of reduction in value, if you have deducted it in your financial accounting, you have to add it back. Okay, you can see my screen now, that's fine. Now, all these are the disallowable items that you have deducted. Now, that you have deducted in your financial statement, which you are going to add back. Now, there are certain things that you have added in your income that you have to deduct. So, these are some of them here include profit on the sale of plant and equipment. Those profits are are not taxable in CIT. So if you have added it, you need to deduct it. Okay, and the same thing too. The loss on the sale of property, plant, and equipment. If you have deducted it, you have to add it back. Now, profit on export sales. You see here, it is going to be deducted. Then non-taxable incomes. There are some income that are non-taxable, e.g., interest on agri or export loans. All the interest that you accrue on export loans, you are going to less them. So when you do all this bit of addition, you got this, bit of subtraction, you got this, addition, you got this, you add to your net profit, you got this, you all the things you're supposed to be subtracting, sum up to this. By the time you subtract this from this one here, you have your accessible profit. Now, it is called accessible profit here, but we know that this is adjusted profit. So, adjusted profit, when there is no loss and balancing charge or capital allowances, that as adjusted profit becomes accessible profit. So, but we can call this one accessible profit one, which we know as our adjusted profits. Now, we will now need to bring our loss before capital allowance. So, section 27 says loss relief is going to be done. Now, when you remove the loss relief, you are getting this balance. It is from here, you can call this one accessible profit 2. You can call this one accessible profit 2. Now, everything under here, after loss has been done, all relates to capital allowance. For example, we have uh, balancing charge. Balancing charge is when you have an asset and you sold the asset. Let's say the asset is supposed to be depreciating. Asset before you sell the asset, there's something they call tax written down value, and there's what they call net book value. So normally, you are when you are depreciating your assets, an asset starts from, let's say you have the asset 1 million naira, and you keep depreciating, and you get 200,000. That's net book value. Now, tax written down value is when you are using tax principles to reduce the value of the asset. Now, let's say the tax written down value happened to be 250, but then you want to sell the asset at 300,000. What does it mean? It means that you have gained 50,000 extra more than your tax written down value. Now, we are not concerned about the net book value, we are concerned about the tax written down value. It means that if you have not sold the assets, that 250,000 will have been reduced in the long run in your account until it gets to zero. If you have sold the asset at 250,000, no problem. There will be no balancing charge, no balancing allowance. Meaning you have gotten the value that government would have given you, because capital allowance is like government is saying all the assets that you bought, we are giving them back to you. Take them, take the money you spent on them. So tax written down value means this is the balance of what government is yet to give you for the assets. So the tax written down value is 250 and you got 300. Government is supposed to have given you 250 in the long run, but you've gotten 50,000 extra. That is an income in the tax eye, in the eye of the tax man. They're going to charge you tax on the extra 50. That is what we call the balancing charge. And we are going to add it because it's an income as opposed to balancing allowance. In balancing allowance, let's say the tax written down value is 250, but you sold it at 220. What have we done? We have lost 30,000. Government was willing to give you 250 in the long run if you have not sold it. But now you have gotten 230 out of the 50, 250. Now government is saying that this asset doesn't belong to you now. You have sold it. The remaining 30 is the balancing allowance. So you are going to less that 30 that you lost as part of your balancing allowance. Okay, so balancing charge, we less it. Investment allowance. When we're talking about capital allowance, we'll talk more about investment allowance. Investment allowance is the allowance government gives you when you invest in plants and machinery. Only plants and machinery, and it's about 10%. In this 2025, I think 2025 year tax year, the investment allowance has been removed. But for your exam, you will still be seeing investment allowance. So we'll talk about it. Invest anytime you see allowance, 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 they are all part of capital allowance, and they are going to be less or grouped together. So you see, investment allowance is being done. Then we have capital allowance, and which is divided into two: initial allowance and annual allowance. When we get to capital allowance, we will talk about them. And of course, we have the balancing allowance. So if you look at this thing here, balancing charge is being added, balancing and investment allowance is being deducted. Normally now, investment allowance has no place with the normal capital allowance because this is an extra allowance given to you. Now, looking at the capital allowance, this is the initial allowance, this is the annual allowance, and of course, this is your balancing allowance. These three, when we add them together, when we add them together, we are supposed to compare them with two third. We're going to be comparing them with two third of our capital allowances that is restricted. You know, there are some companies that they will be paying two over three, 2/3 of their capital allowances is being restricted. Two of their two-third of their capital allowances is being restricted as what they will pay. Meaning that if their total capital allowance is say 900,000, 900,000, that's the total capital allowance. And let's say, okay, let's say their capital allowance is the accessible profit is 900,000 a bit. This is the accessible profit. And let's say their capital allowance is 500,000. You cannot just remove this 500,000 from this 900,000. They will look for 2/3 of 900,000, which is 100,000. Now, 2/3 of 900,000 is 600,000. So, if they have a capital allowance of 500,000 and the maximum that they can remove is 600,000, it means that this 500,000 can be deducted all at once. 500,000 was 700,000. and the maximum deduct is 600, so 700, only 600 can be deducted. Now, you see, you have 700 to deduct from 900. Your tax would have reduced drastically. But the law says you can only deduct 600, meaning that 100 will be carried forward. There are some companies that has that kind of provisions. Okay, so what you get down is your total profit. So your total profit is what you will get after all of these things has been done. Then we will now have to calculate our income tax using the applicable rates. We have the income tax, which we said before, we have 0% for small companies, 20% for medium companies, and 30% for big companies. So that is when you now apply your tax on it. Then you will now apply education tax. It's now 2.5% for for medium and large companies. A small company do not pay education tax. This is because for income tax is already 0%. So that means their own TET is also going to be 0%. So when you do that, you have your tax payable. The tax payable, you add the education tax with your you add the education tax to that of your profit company income tax, and you get your tax payable. So when you pay your tax, that's it. So if you have to, that means that that's the tax you are going to put in your financial reporting. So you see financial statement, sometimes you see profit before tax, then you see taxation. It is this tax payable that is being put in there. Then they will refer to the notes to show how this tax was computed. Then you now see profit after tax. So financial accountants can now use the profit after tax to now determine what the dividends will be like, dividends or the retained earnings. So we've seen the format of total profit, how the total profit is being arrived at. We're going to be looking at this format a whole lot in our taxation classes. So this is what we are going to be looking at beginning from this class. This is what is going to be our song. Special education tax. Just a moment. So, tertiary education tax. What is this tax? This is a tax that was introduced into the Nigerian tax system through the Education Tax Act of 1993. This is even before the Constitution of Nigeria was done in 1999. Then it now metamorphosed into the Special Education Tax Act of 2004, which was now repealed or replaced by the Special Education Fund 2011. And the aim of this is to provide education sector um, with funds. Normally, the education sector usually suffer from financial allocation in the budget. So much attention is not being given to education. Now, the tertiary education, which is normally we say education is the bedrock for a nation or for a society, and they say the leaders of tomorrow have to be educated. And so, but instead of government paying more attention to education, they pay more attention to some infrastructural things that education seems to be at a disadvantage. And so the government look at ways in which to revive the education sector by asking companies that are also a stakeholder in the economy to come to the aid. So private sector company, which is limited company, the public limited company, so the PLC and the LTD companies are now being tasked to contribute some portion of their profit to the tech fund. And so that is how the tech fund comes. So note here that business names, individuals, and foreign companies do not pay tech fund. Only Nigerian limited company and PLC pay this tech fund. Now, this fund is used for the provision or maintenance of physical infrastructure for teaching and learning, instructional material and equipment, research and publication. Research and publication. Otherwise, my screen blank. Just a moment. Just a moment. Why is this screen so blank? All right. Then we have academic staff training and development. Now, the basis for computation is 2% of a of the accessible profits of any registered company in Nigeria. Now, when we say 2% of accessible profits, we are looking at accessible profits one. That's one we call adjusted profits. We calculate 2% of it. So once we adjust our profits before we calculate loss relief and capital allowance, the special education tax is chargeable from that loss relief. Now, all companies, whether small or big, usually pay that 2%. And normally, we have 60 days RS has imposed their assessment on us to pay this tertiary education tax. But now, when Finance Act 2020 came, which was effective in the year 2021, small companies were not liable to pay tertiary education tax. Normally, the because the small companies are having 0% of income tax, so it mandates them that your own tertiary education tax will be 0%. All right. Now, the FRS is the custodian. They are the people who help the government to assess TET, we'll call it TET for now, and they collect the taxes from the companies. Now, because company all pay their taxes to the FRS, so where you pay your CIT, That is the same place you pay your TET. And so they help collect those funds. Now, when assessing a company for company's income tax or petroleum profit tax, the FRS shall also proceed to assess the company on education tax. We said that, and that is true for all cases of company, both oil companies and non-oil companies. We will not be dwelling much on this provision because there is a separate topic for tertiary education tax. So, but what you should know here that after collecting this tax, the the cost of administration and management of the fund, the TET fund, as a percentage that is usually being deducted from the total sum. Then the remainder of the sum, they are now using it to fund the tertiary education sectors, which we have the universities, the polytechnics, and the college of education. We will not be talking much about the composition of the board, but you can go through it. We will cover the tax administration in Nigeria. These are the same things. Consist of the chairman and other people that makes up the board of trustees. That's not too important for this particular class, but it's important you go through them. Okay. Now, what is also important now in this class is that after the federal inland revenue has deducted their commission, I think it's 5%. It's 5%. So let's say um, they have 1 million naira. They will collect 5% of it as commission. Then the remaining money is being shared in the ratio of 2:1:1. So that means 50% of the remainder goes to university, 25% goes to polytechnic, 25% goes to colleges of education. All right. And now the offenses and penalties, 5% is being taxed as the penalty for not, paying your tax on time. And if you are guilty of an offense of either not deducting or not remitting, you pay a 1 million naira fine for or imprisonment of a term of 6 months or for both. If you're a second offender, then you have 2 million naira or imprisonment of 12 months or both. Go through them. These are minor aspects of this particular class, which I will want you to look at. Now let's look at a question here. Let's attack this question. Zipon Nigeria, Zipon Limited, extract of operating results as per audited financial statement for the year ended October 31st, 2013 is as follows. Now, one thing you should know here is that although in the next class we'll learn about it, we have what they call year of assessment and we have what they call basis period. And so this year ended is the basis period. That is where the basis period is ending. So it means that if it is year ended and is ending at this date, which is called 31st of October 2013, and it's year end, it means it's 1 year. It must have started November 1, because I started November 1 of the previous year, ending in 31st October of the 2013. So that is your basis period. Then there's something they call preceding year basis. So when they say precede, it means before or comes before. So when they say preceding year basis, it means the year before basis. The year before basis. So this year of assessment, your basis period must precede it, meaning that this basis period comes before the year of assessment. You cannot be assessing me to tax in the same year that I'm making the profit. I must have made the profit first, then you charge me to tax later. It means that your basis period must end, and the next year is your year of assessment. So it means that if the basis period has in year 2013, your year of assessment should be 2014. And so it means your basis period precedes your year of assessment. You are using preceding year basis to charge it tax now. To get that fact, we'll still be repeating it in our subsequent class. Now we have the operating profit. So this is operating profit. This is provision for depreciation. This is interest on borrowed fund. So this one is income. This one is expenses. This one is expenses. This one is expenses. Balancing allowance is going to be deducted. Balancing charge is income. Stamp duty of this is expenses. Capital allowance is expenses. Now we are told to compute the assessable profit and tertiary education tax. Assessable profit and tertiary education tax for the relevant year of assessment. So this is our ZIPON limited. So we'll go here, exercise 1 or illustration 1. Let's say this is, what's the name of the company again? ZIPON limited. Okay, so we are asked to do what? We are asked to do assessable profit and tertiary education tax for year of assessment 2014. They won't tell you the year of assessment. The question told you relevant year of assessment. Now we said it is preceding year basis. They have given you the year end. Whatever year you see here as the year end, the next year. So what do we do now? So let's check. We are starting with assessable profit. How do we compute the assessable profit? So one, you were not given the net profit. So we're not using the net profit method. We are going to be going from beginning. Okay, we are giving the net profit is operating profit. Yeah, this is profit. We are giving the operating profit. So we start from there. We say net, okay, this two naira sign here. Net profit as per account. How much is that? We have 1,490,000. 1,490,000. Okay. So the next thing you do here is what are those income that has been what are those income that are not supposed to be taxed? There are no income here. We'll treat balancing charge later. We'll treat balancing charge later. So, but what happened here is this is our profit. We'll now look at those expenses. So we've taken this one. We'll now look at those expenses that are not allowable. So we'll add back this allowable. We'll say add back disallowable or disallowed expenses. So what are those expenses? We have provision for depreciation. We say provision for depreciation. How much is that? Is done this 610. That will be 610,000. The next one is this is interest on borrowed funds. Interest on borrowed funds. So you borrow these funds on interest. So your interest is an allowable deduction. So we are not going to treat this. We will not touch this because interest on borrowed funds is an allowable expense. Provision for general debts. This is a general provision. We are going to treat it. We are adding it back. So we are adding this provision of general debt 390. Provision for general debt 390. Okay. We leave this balancing allowance for now. We'll go to stamp duty on increase in capital. Now, this stamp duty is a capital expense and we are supposed to add it back if we have deducted it. So this 180 stamp duty on increase on capital, stamp, stamp duty on increase in capital 180. Okay, we've done all that now. So let's look at what it's going to give us. So let's activate our calculator here. We have our 610 plus 390 plus 180. That gives us 180. One, excuse me, 180,000. You add them together. So I'll do the calculator again. I add it to my 1490. I'm having 2670. So I have two 670,000. Now this 267,000 is supposed to be your adjusted profit. So we will now check for loss. There is no loss here. We now look for capital allowances. So the first thing to do is to add balancing charge. What is our balancing charge? Our balancing charge here is 220. You add 220. You add them up. This gives me 2,890,000. So you will not less. What are you lessing? You are lessing balancing allowance and capital allowances. So you now less balancing allowance. Balancing allowance here is 290. Okay. Then we have capital allowance as agreed. Now you don't have to restrict it because this is what was agreed. It has been done for you. Capital allowance 610. Capital allowance 610. Will you add these two here? Let's see. 290 plus 610. That gives you 900. So that will give you 900,000. So we are supposed to less it. So you less 900,000 from, okay, I didn't add this 220 here. We're supposed to less 900,000 from 2,890,000. So let's less our 900,000 and we are left with 1,990. 1,000,000 1,990,000. So this will now be your taxable this will not be your taxable profit. This will not be your taxable profit, and this is supposed to be your assessable profit. This also your assessable profit. So what we are asked to do here is to look for accessible profit. That's what the question is asking us. Looking for accessible profit and TET. So what should we do? We will say accessible profit, which is that adjusted profit that we calculated before, But that's where our TET is based on 2670, 2,670,000. Then our tertiary education tax. Based on 2014 year of assessment, it was 2% on assessable profit based on that year of assessment. So it's going to be 2 over 100 multiplied by 2,670,000. So 2 divided by 100 divided by 2,670,000. So that will give you, we multiply by 1,000. So that will give you, let's do it again. 2 divided by 100 multiplied by 2,670. Good. That's going to give me 53,400. 53,400. This is a special education tax. And let's see how it is being solved here in ICANN study pack. And that's the same thing we did. That's the same thing we did. So remember, they called it accessible profit here. I told us it is still accessible profit, even though we know it as our adjusted profit. I went ahead to do other things I didn't do here, but I did that for the purpose of showing us total profit, which is our topic for the day. But they stopped at accessible profit, which was what the question was asking you, and they calculate 2% on accessible profit. Now, from Finance Act 2019, all Nigerian companies are liable to the same company income tax rate of 30%, with the exception of um, prior to the commencement of Finance Act 2019, all companies were being charged CIT at 30%. Small businesses was charged 20%, and small businesses was known to be businesses with 1 million naira turnover or less. That was what was being carried on till 2019 Finance Act, which started 2020, which changed the definition of small business from 1 million to 25 million and exempt them from tertiary education tax. Now look at the size of the current company's turnover and the applicable tax rate. Small companies we see it as 25 million and below, 0, medium size between 25 and 100. So it means um, 25 million to 999,900. That's going to be 20%. The moment it hits 100 million, you start paying 30%. Let me see what's happening. Why is this to show me blank screen? Just a moment. All right. So, implications of classification of Nigerian companies. Now, small businesses are still required to register for tax and prepare audited financial statements. Now, why are they required to register for tax even though they're not paying tax? This is because any moment their income can increase and enter the threshold for taxation. And so if they're not registered for tax, how then will they now file their tax? So they are going to be registered for tax prior to when their company's income or turnover gets to 25 million. And they will still be filing zero tax. So the company is being monitored, their income turnover is being monitored until when it gets to 25 million, they start paying um, income tax. Small companies are no longer liable to withholding tax in their income. So normally, a small company is not liable to withholding tax. But in practice, the FIRS still collects from small company. If you are doing business with a company, the company is liable to withhold tax from you. So, but because you are not supposed to pay tax, government is supposed to refund it back to you. So, but I think with the new regulations, they're not supposed to collect withholding tax from a small company. So it means that you have to show proof that you are a tax compliant person and that the previous year you have not hit the 25 million mark revenue and you're not paying tax. For you to qualify to enjoy this no withholding tax on your income. Otherwise, the company that is supposed to pay you will withhold the withholding tax. So from Finance Act 2020, the FRS may prescribe the form of accounts other than audited statements for small and medium sized companies. So it means that sorry, it means that small companies that are not paying taxes are not even obliged to hire an auditor. And so FRS they say, okay, instead of submit audited statements, look at how you submit your statement that will be acceptable. Right now, they're accepting management accounts, management management financial statements, which is still prepared like the audited statement, but you won't be seeing auditors company and auditors comments, auditors reports will not be there, and so they will submit it that way, and it's acceptable. All right, so we look at normal basis for computing income tax. Now, in line with the provision of the Finance Act, companies are computing their income tax on their total profit. So the basis for computing income tax is from total profit. So it means that it is from your total profit that you charge your tax. So it's either you charge 0% for small company, 20% of TP for medium size, and 30% of TP for large companies. But now there are some other abnormal bases for computing income tax. Now we said normal basis is from total profit. Other basis, I call them abnormal, is from minimum tax basis, which we see in section 33 of CETA. Then there's what they call revenue turnover basis. Then we have dividend basis. Now let's briefly look at these bases. Now, in minimum tax basis, according to the amended Act by the Finance Act 2020, gross turnover. Now, gross turnover means the gross inflow of economic benefits during the period arising from operating activities. When this inflow results in increase in equity other than when we are contributing shares, so which includes sales of goods, supply of services, receipt of interest, rent, royalties, or dividends. All of these things will add up to your turnover. Now, in minimum tax basis, the company with a gross revenue of 25 less than 25 million, once your gross minimum is less than 25 million, you are not uh, paying minimum tax. You are not paying minimum tax. Also, if you are involved in agricultural business, you are also exempted from minimum tax. Then, if you have been in business for less than 4 years, 4 calendar years, which is 48 months, if you have been in business for less than 48 months, you will be exempt from minimum tax, which means that if you are having a gross turnover of 25 or more, you are supposed to pay minimum tax. But if you are within your first 4 years, it will be exempted. Now, agricultural business, whether they are in 4 years, less than 4 years, or more than 4 years, they are exempted. Uh, Less than 25 million gross turnover, whether more than 4 years or less than 4 years, they are exempted from minimum tax. Now, we know something called frank investment income. We will be seeing them when we are taking the next topic, which is going to be taxation of investment income. A frank investment income is dividend received by one company from another company after the deduction of withholding tax. We'll talk more about it when we are talking about dividend income. So, any dividend received without the deduction of withholding tax will not be deducted from the gross turnover in the computation of minimum tax liability. This is because they have not deducted uh, withholding tax. So that means it is no longer a frank investment income. But once it is frank investment income, it has suffered withholding tax. That dividend, as it is being received, when you are calculating your gross income, you need to deduct that revenue, that dividend that is called frank, that is called frank investment income. So it means that this income will be adding up to your income, but because it has suffered withholding tax, it is going to be added to your income to show income from all sources and is going to be deducted because it is frank investment. But what makes it frank investment is because of the deduction of withholding tax. So it means that anyone that is without the deduction of withholding tax can no longer be called frank investment income. And so when that income is added to your gross profit, it will not be deducted again. It will remain there. Evidence of the deduction of withholding tax deducted as source is a condition precedent before you treat any dividend as frank investment. So it means this withholding tax is the key to qualify a dividend as frank. Where the frank investment income will not form part of the gross turnover, that is frank investment income, will not form part of the gross turnover, it should not be deducted from same in minimum tax. So it means that if I'm calculating all my income from all sources, normally I am supposed to add my frank investment income to show all the income I have made for that year. Later, I'm supposed to deduct it to show my gross income. So now there's a difference between income from all sources and gross income. Income from all sources is every income you derive, whether they are tax deductible or not, list them. Agricultural income, bank investment income, you list them. Then that's income from all sources. Now you now deduct agricultural trade income. Now it's deducted, although you've added it before, you are not deducting it. Then frank investment income, you deduct it, you get your gross income. Is that gross income that you use to calculate your minimum tax. Now we are saying that when you are showing your income from all sources and you didn't put your dividend income, you cannot now be deducting it from gross income again, because in the first place it was not part of your income from all sources, so you can't deduct it again. So it is only when it is from your income from all sources that you can deduct, and the basis for deducting it is because it has suffered withholding tax. All right. Now, minimum tax is 0.5% of gross turnover. 0.5% of gross turnover of the company. Of course, less frank investment income. Now, based on Finance Act 2020, minimum tax is computed at 0.25, which is half of this, of gross turnover for assessment years falling between January 1, 2020 to December 31st, 2021. It means you are going to use it only once for either 2020 or 20 of assessment. You have to use it for only once. Why is it so? It's because of COVID. So this is like a palliative, and they say instead of using 5% for either of this year, you pick one year that you would like to use 5% on your minimum tax. Okay, so let's look at this illustration. Okay, ATAX Nigeria Limited. So let me take the name down because we are going to be looking at this question. Oh, don't like this color. Let's take this. ATAX Nigeria Limited. All right, has been in the business for many years. An extract of the profit and loss account for the year ended December 31st, 2021. I'll immediately do something here and I will say year of assessment is 2022. So what it means here is if you are asked to calculate minimum tax, you cannot use 0.5% or 0.25% because the year of assessment is 2020, 2021 that qualifies it, but now this is 2022. So it means minimum tax will be 0.5%. 5%. We don't know else what they're asking us to do, but I've slightly looked at the required. The required is telling us that minimum tax payable. So I'm just linking it up here that the minimum tax will be 0.5%. Now, let's calculate revenue from all sources. Revenue from all sources. Okay, so this is revenue from main business activity, 25 million. Now we have revenue from 3.5 on the suspended, it is 2.4 million. Now this profit from suspended operations is being brought here. So this is profit, and now this is profit from all activities, further all operating activities. We are not asked to calculate profit, accessible profit. We are asked to calculate minimum tax. And what is our basis for minimum tax? The minimum tax is um, 0.5% of gross turnover. So we'll be looking at gross turnover now. We'll be looking at gross turnover less grant investment income. Okay, so let's see. Let's bring out all the turnover from main business, 25 million. So it has reached the threshold. Has reached the threshold. That's what we should know. It has reached the threshold. So it is qualified. Turnover from main business, it has reached the 25 million. If it has not reached the 25 million, we won't be doing all of this. So we have revenue from suspended operation, 3.5 million. Revenue from suspended operation, 3.5 million. Then we also ignore, so we've taken this, taken this, taken this, we ignore this. Then this is rent received gross. We're going to take it. Rent received gross is 750. Rent received gross. Now, how much is that? 750. Mind you, if they have told you net, we would have grossed it. Why? Because we are looking at gross turnover. So all our things are supposed to be gross. So we've taken this, we've taken this, taken this. Dividend received from APD Limited. So this is dividend received from APD Limited. Now, this is, I think this from here is buy. That's what they intend to say buy. Dividend received by LPD Limited. That's why it is a revenue. If it is from, it's going to be an expense. So it is by. Dividend received by, it means that the ones receiving it which is 2.4 million. We take it, it is revenue, we call it revenue, or just a dividend. Let me call it dividend. Dividend received. Dividend received. Gross 2.4 million. So this is dividend received by them, not received from them. If it is received from them, these they are the ones paying out. So that will not be an income. But this is dividend received by them. Then we also have revenue from other operating activities. We are going to take this 7.5 and ignore this 7.5. Revenue from other operating activities. Revenue from other ops activity 7.5 million. So this is going to give you income from all sources. So let's get that. I have 25 million plus 3.5 million. I have 750,000 plus 2.4 billion plus 7.5 million. 39,150. So after that, you now say less fund investment income, which I will call is dividends. So although dividends received at gross, we are assuming that the withholding tax has been deducted. So irrespective of the fact that withholding tax has been deducted, we are adding back the withholding tax to report it at gross. It was paid to us at net, which is net of withholding tax, but we record it as gross, as if the withholding tax was not removed, because we are looking at our gross. So we've added gross here. We are going to remove the whole of that figure. So what do we have here? We have minus 2,400,000, 36,750, 36,750. So this is your gross turnover. So from what we read before, if this 2.4 million had not come here, we would not have deducted it here. It means that it did not appear at all, and so it's not going to be deducted at all. But this way of making it to appear here and deducting it here is best, so that the government or everybody knows that this revenue was made and is deducted by law. If it didn't appear here at all, it is as though you are hiding to disclose this revenue. If it didn't appear here at all, when we add everything, we'll be getting 36,750 like this before. But you have to disclose it, then use the law to remove it. You have to show proof that withholding tax was also deducted here. That will be the basis of treating it as FII. Then we are calculating minimum tax. Let me use here minimum tax, which is 0.5. Is it 0.5? 0.05. Let me confirm. 0.5% of GT. So let's calculate it. So we multiply by 0.5 divide by 100. It means you are paid 183,750. 183,750 as your minimum tax. So let's see what was recorded here. Wow, they use 0.25, and I disagree with that. I disagree with that for using 0.25, because based on what we learned here is for 2021 years of assessment, 2020 year of assessment, and okay, I understand what they did here. This is basis period. This is basis period. So any activity that you did between January 1, 2020 to December 2021, you are going to. So it means here it is basis period. I beg your pardon. So it means years of assessment 2021 or 2022 is for basis period between January 1, 2020 and December 31st, 2021. So 2021 year of assessment or 2022, we use one. So we are going to be using, okay, let me use the basis of assessment. Years of assessment 2021. I failed to put that. So I'll change this now to 0.25. All I'll need to do in my previous calculation is just to divide this by 2 to meet the requirement. I want to times by 2. Let me divide by 4. Okay, so I've gotten it 91,875. 91,875. Some people will be wondering why I went to divide by 4. Let me do it again. 36,750,000 times 0.25 divided by 100 gives me the 91,875, which is what was gotten here. So that's it. Let me refresh this, but it will be showing completely. All right. Then the next one is revenue turnover basis. Revenue turnover basis. The first one was minimum tax. We've seen how minimum tax was calculated on minimum tax is on gross revenue. but it's called minimum tax. Now look at revenue basis. You'll be wondering, minimum tax is on gross revenue. What then is gross revenue basis? We now say that gross turnover means all the income that we got less frank investment income, isn't it? All right, so that is what we know. Now, sometimes the FRS is given discretionary powers. So the emphasis is on discretionary power to assess and charge a company to tax on a fair and reasonable percentage of the turnover. So FRS will say, okay, we are not going to use minimum tax for you. We are going to use revenue basis. And there's a reason why they do that. Some of the reasons include the company may have no accessible profit for that year. And so because they don't have accessible profit, they may not be charged to company income tax. But they have revenue, and the company perhaps is not within the the they are exempted from minimum tax. They are exempted from minimum tax. Maybe because they are in the two less than 4 years, maybe because they are carrying on agricultural business. But now they're supposed to be paying tax. They don't have accessible profits, and so they cannot pay tax. Now, even though they have accessible profits, it seems to be less than what is supposed to arise from that business. Or when they cannot readily ascertain what the accessible profit is. They say, okay, no problem. We are having difficulties finding the accessible profit. Let us use revenue basis. So mind you, we are going to use a fair percentage. The implication of the above provision is that whatever is obtained by applying a fair and reasonable percentage as determined by the FRS to the company's revenue is deemed to be the accessible profit for the year. So that fair percentage that is applied to your revenue is deemed to be your accessible profit for the year. And so tax can now be charged on that. So normally, most times when they do examination, and you'll be seeing them deemed revenue, deemed accessible profit, they have applied a small percentage. Now look at this. We have a revenue of 100 million. Accessible profit is 8 million, 5 million 850. Balancing charge is 500. You add them to get this. You now less loss relief and you get this. You brought your capital allowances 2,500,000 and you're having 2,650,000 as a total profit. And now the company is liable to pay 30% of 2,650,000, which gives me 795,000. Okay, now this is what they would have filed to the FRS. Now an extract from the company review the following. We have gross profit, net assets, share capital, and stakeholders fund. I call this gap GAAP. This gap here, G means gross profit, the A means assets, net assets, then The um, I mean, T, GAP, sorry, I call it GAP T. Then this P is paid up capital. Then this T is turnover. Okay. So previously, they usually calculate your your minimum tax based on this GAP T. But now look at what they said here. A debt examination by the Inland Revenue revealed that revenue was understated by 5 billion. So it means that this revenue that is 100,000 is not the complete revenue. They didn't have 5 million added to it. So you add it, it's supposed to be 105. Now they also said that expenses was overstated by 1.5. The tax official observed that the accounts submitted by the company were not reliable and that based on industry average, the gross profit percentage of 10% reviewed by the company's account was not reasonable. Accordingly, the revenue decided to revise the company's income account computation by applying a fair and reasonable percentage of 25% on the revenue. Now they said they compute the company's income tax liability for 2021, ignore minimum tax. So what's the name of this company now? The name of this company is Ojokoro Nigeria Limited. I call it Ojokoro Nigeria Limited. What are we asked to find? We're asked to find income tax liability for 2021. Income tax liability for years of assessment 2021. So the first thing we are going to do here is to bring your revenue. So we use this revenue reported was 100 million. Revenue understated that was not reported 5 billion. What again? We have balancing charge 500,000. Balancing charge 500,000 because it will form part of your revenue. What else again? So since it is revenue basis, that's what we are only calculating revenue. That's the only thing that we are after. Is there any gross dividends? There's no dividend here, so no mention of dividend. So this is our gross revenue. So this is going to be 105,500,000. This is our gross revenue. Then we say deemed accessible profit. We will now look at 25% of gross revenue. So we say 105,500,000 multiplied by 25 divided by 100. So 26, what am I doing? Yeah, 26 million 375. 26 million 375,000. That's your revenue, your accessible profit. Then we don't have a capital allowance here, do we? Okay, we have we have loss brought forward, loss brought forward 120 less the loss brought forward 120, sorry, 120, 120,000 less that. What am I doing? 1,200,000, 1,200,000. Beg your pardon, 1,200,000. Then we've treated balancing chart we added. Then we are going to remove capital allowance 2.5 million. Capital allowance 2.5 million. So your total profit is going to give you what's the figure here now? This minus 1,200,000 minus 2,500,000. That gives me 22,675. Sorry, there's a delay with my writing in the system. 22,675. That's the total profit. So it means your CIT, this is a big company, is going to be at 30%. 30% is going to be multiplied by 0.3, 6,802,500. 6,802,500. Now this is your capital, your CIT. So you can decide to do your minimum tax because this business has been in for many years. Okay, they didn't tell us for many years. They didn't tell us that it is within the first 4 years, so it is not exempted to minimum tax, and it is engaged in general merchandising. Then there's something we have omitted. Our capital allowance is supposed to be restricted to third of accessible profit. So let's even do the third of accessible profit to see 26,375,000 times 2 divided by 3. Okay, 17,583,000. But we're only bringing 2 million. So yes, we are within our rights to use our 2 million. Assuming that the restricted amount is less than this 2,500,000, we would have used that restricted amount. So we are correct to use our 25 million, 2.5 million. But whenever you are doing your capital allowance, always check the restricted amount whether it is large enough to accommodate that. Minimum tax is supposed to be 0.5% of revenue plus turnover here, 105,500, 1, let me just say this is 30% of total profit. Let me not write this one like this. 0.5% of gross turnover. Now, gross turnover, we said it was 105,500. So let's look at it. 105,500,000 multiplied by 0.5 divided by 100. 527,500. 527,500. Of course, it is lower than our CIT. Of course, our CIT is going to be this. Then you are going to calculate your tertiary education tax. In the question, they told us to ignore minimum tax. I remember when they said that, ignore minimum tax. I still purposely went to calculate it. But don't do like me in the exam. If they told you to ignore it. Tertiary education tax, what year is this? This is 2021. So it's 2.5%. 2021 year of assessment is it 2021 or 2022? 2021 is 2%. From 2022 that it became 2.5%. So this is 2% of accessible profit. So what's the accessible profit? This is the accessible profit here. 26,375 times 2 divided by 100. 527,500. Hmm. 527,500. This is the special education tax. So let's see what I can did. We might be getting something slightly different. Let's see. They brought their deemed accessible part. Okay. The difference between ours and theirs is that the revenue is still the same. Uh-oh. The revenue is still the same. This plus this. Okay. They didn't use the balancing charge. was not included in the computation of revenue, which is still fine, and they apply 25%. So this 25% effectively the balancing charge. In theirs, it didn't affect the balancing charge. And so they have 26,250 and we have 26,375. It's because of the 500,000. It's not a big deal. Then we now added the balancing charge and we got 267.50, no problem. Then we now less this unrelieved loss and we now less capital allowance and we got total profit 23,000 and 23 million and 50 and we are getting 22.6. So you see the way we complete our own, we are even paying lesser tax and the way government would have want us to compete. But it's fine. And so you see their CIT, LCIT 6802, your own is 6915, so they are paying more tax, and that's it. They didn't complete education tax. But suffice it to say, this is correct too. You get the same mark with the Excel. The only difference was here you added balancing charge to your revenue because it's still something that will be charged. But I think I prefer the way I can did it here, although it's bringing more tax. Just the revenue is what you just deal with. Then you add the balancing charge to the accessible profit. It's fine. All right. So the last one we'll be taking is dividend basis. The dividend basis is to determine your tax based on dividend. And when there is a dividend paid out of profit in which there is no tax payable due, that is when you now charge dividend basis. So you're having a total profit of zero. You don't have any total profit, and so there is no tax due to you. But you are paying dividends. You don't have a profit. You are paying dividends. You don't have accessible profit, but you are paying dividends. Or you have accessible profit, but the money you are paying as dividends is bigger than that of accessible profit. So the company is going to pay they're going to pay tax on the dividends that they are paying out. It means that when your dividends when your dividends paid out is greater than your accessible profit, your dividend is seen to be your accessible profit for the year. And so what it means is that whenever you are paying dividends for a big company, as you are paying the dividend out, you are being taxed 30%. Now, in the case when you now declare your accessible profit, okay, your dividend, sorry, is not um, your total profit, no accessible profit, is greater than your total profit. So when your dividend is greater than your total profit for the year, your dividend is taken as your total profit. So when you check your dividends, you pay 30% out of the dividends you declare. By the time you declare your accessible profit and you now go to your total profit and you now pay tax of 30%. Normally, you're supposed to pay tax of 30%. If this total profit is okay, let's do something here. Let's say your dividend you paid 1 million and your tax is 30%, which is 300,000. Then the cost of your doing your profit and your dividend, your total profit. The total profit now happens to be 600,000. You see, it is less than your dividend. Normally, you're supposed to pay 30% of 600,000, which is 180. But because this total profit is less than dividend, they've already paid tax on dividend. So this is taken as your total profit for the year. So you have to pay tax on your dividend as you are paying tax. So as you are paying tax for your dividend, as you are giving out dividend, normally you are collecting withholding tax. You are also remitting tax on dividend. But let's assume that your total profit happens to be 1.2 million and you now pay 30% on it. Let's say 30% gives you 400,000. Let's see if it's so. 1,200,000 times 30%, 360. Good. Which is now 360,000. You have already paid 300,000 as your dividend tax. All you need to pay is the difference of 60,000. So it means that your total profit is now your total profit, and your dividend tax is seen as an advanced tax on your total profit. So that is it. So if you look at this company now, XYZ financial statement and XYZ for 2020, this is the total profit for the year. This one has 360, 3.6 million total profit. The XYZ has one a negative balance. That means they don't have profit and loss for the year. They don't have total profit for the year. They only have loss. So it means the total profit is zero. Retained earnings brought forward. Look at what they brought forward and look at what they declared as dividends in 2020 and paid in 2021. So now it means that this dividend of 4.2 paid out is deemed to be their total profit. And you see it is higher than 360, 3.6. And here, this is 750,000, is higher than the loss. So it means that out of the dividend of 4.2 declared by ABC, only 600 can be regarded as having paid out of retained earnings. Why is this so? Let's see. 3.6 minus 4.2. So that 600 they are saying. Out of only 600 has been regarded as having paid out of retained earnings. Hence, 3,600 shall be subjected to application of section 19.1 of CITA, which says that dividends paid out of retained earnings of the company, provided that the dividends are paid out of profit that have been subjected to tax under Company Income Tax Act, or so shall be liable to tax. So, so um, this 3.6 shall be subjected to tax, and this 602. Okay, so what happens here is that this 4.2 million. Okay, this 3,600 is what is subjected to tax. not this 4.2. Okay, only 600 is 600 is paid out of retained earnings. So this 36 is not paid out of retained earnings. So that is why it is subjected to this provision. But here, 750,000 is not subjected to that provision. And so you are going to be paying the tax on the 750. All right. So, so far so good. We've completed the, the three bases of abnormal basis for computing taxes when it is not collected from company income tax. So we want you to look at this undistributed profit of a Nigerian company and anti-abuse. We are still going to see them again when we get to taxation of investment income, which is likely the next topic we are going to be taking. So what have we learned today? We have seen that total profit is the profit that is charged to tax and is derived from your accounting profit, which has to be adjusted by the taxman to give you adjusted profit. Then we adjust it for um, balancing allowance, no balancing charge and balancing allowance, which comes after loss relief has been taken into account. Then capital allowance. Your capital allowances comes after your loss. Then we have your accessible profit. Accessible profit, sorry, we have your total profit. We have your total profit. The adjusted profit comes when you change from accounting profit to tax profit. So by the time you remove your loss and your capital allowance, it becomes your total profit. So that adjusted profit is still your accessible profit, which is calculate your tertiary education tax. We saw the provisions of the Finance Act where tertiary education tax um, is charged to small, to medium and small companies because small, medium and big companies rather because small companies are having a CIT of 0%. We saw the provision of the Finance Act during COVID period where minimum tax is being charged at 7.2, 0.5 for 2021 and 2022 years of assessment. We also saw the revenue basis where they will get a small percentage, fair percentage on your gross profit, or your gross income rather, as your bid revenue for the period. And we saw the dividend basis where we saw how dividend is paid, you pay tax on dividends as if it is a total profit. So I would like you to do this open-ended questions, look at the solutions. If you do not understand the solutions, feel free to revert back to me so that we can discuss about it. With that, we come to the end of today's class. It has been an eventful class with some calculations, and I'll be happy if you meet your mic now, if possible, and ask your questions. I'll give us 1 minute to ask our question. If no question, we take it as if we understand the topic treated below. And you can take questions also privately. Ask me questions on my WhatsApp. I'll be glad to answer you. But please do those exercises in this workbook that we have used. Try to understand the solution. First of all, solve it yourself before checking your answers. And also look out for past questions on this topic and see how you can um, use that questions to understand the topic clearly. With that, we come to the end of today's class. Into class, the next class.